Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and on this show, we're going to be focusing on a very important but often less understood topic, and that is term insurance. Now, to help us understand everything that you should know about term insurance before purchasing one, I have an expert joining in on this show with me. A very, very special person, Sajja Praveen Chowdary, joins in. He's the business head, Term Insurance Life at policybazar.com, joins right in. Sajja, welcome to Business Today TV, and great to have you with us on this very special edition. And this topic, I'm sure, is very, very close to your heart. Day in, day out, you speak to your clients. So many people resolve so many queries on an everyday basis. So who better than you to help all our viewers really understand on a basic level what exactly is term insurance and how is it really different from, say, ULIPs and other life insurance policies that exist?
Thanks, Sakshi. So basically, term insurance is one of the types of life insurance policies, but it's the most economical life insurance policy, I would say. Basically,
Okay.
a term insurance policy is something which can give you a very, very high cover, like, say a 1 crore or 2 crores. I'd say, as less as premium as, say, 500,000 rupees a month, kind of, a term insurance policy works like this, that, in case you pay a very, very small amount of premium every month,
Right.
and you decide how long do you want to cover yourself for a very large cover. As I said, probably a 500 rupees per month for the next 30 years for a cover of, say, 1 crore or 2 crore rupees. And then you keep paying this 500 rupees every month. And in case of death occurring anytime during the 30 years, your family gets this 1 crore as lump sum, as a death benefit, as a payout that the family gets, which will take care of their financial needs and future needs in your absence. That's what the exactly term insurance does. So how is this different from any other product is, the amount of premium that you pay is so small compared to the amount of cover that you get. Whereas when you compare this with any other kind of life insurance policies, whether it's ULIP or, say, endowment policies and all, the cover that you get versus the premium that you would pay would not be that huge. For example, if you want a 1 crore kind of a life cover in a ULIP or, say, an endowment plan, you have to pay a premium of, say, about 10 lakh rupees every year, which is roughly about 80,000-90,000 rupees per month, right?
Oh,
So because
okay.
because all of those plans have a 10x multiple for premium to life cover that you get. So for 1 crore rupees of premium, 1 crore rupees of life cover, you'll also get something back at the end and so on and so forth with returns and all of that. But for 1 crore sum assured, almost end up paying about 10 lakh rupees a year, which is 80,000-90,000 rupees per month, versus where here you're paying about, say, 500 rupees to, say, 700 rupees per month. And you don't get anything back, but that 500 rupees to 700 rupees is so small compared to the 1 crore life cover. So that's how,
Okay. Understood.
you can differentiate a term plan from, say, other categories of life insurance products.
Okay, understood. So a term plan is more economical, gives you a larger cover. On the other hand, some endowment plans or ULIPs may actually give you a higher cover only for a very high premium that you may incur. However, there is some kind of a return. I think this is one factor that most people get lured by. Most people in India have this thought process that, in case they are investing in their policies, they should get something in return. So they actually think of insurance as an investment rather than a risk cover or something like that. So could you explain to all our viewers why should they not think like what is a common thought process, while buying an insurance policy?
See, everyone has different needs in their life, right? So when you look at any kind of financial planning, the basis of a financial plan is always to cover your life first to the extent that tomorrow, in case of your absence, your family's financial future is taken care of. And, they don't face any kind of trouble. So if you are not there also, their financial future is in a similar position as what you would, had been if you had been there around and you've been taken care of. So that's what the basis of any financial plan should start with, and that's where the term insurance comes from. Unless you're a person who has so many crores of assets and say I really don't care about rest of the stuff, then that's a different thing. Otherwise, that's where you start from, which 99% of the people in this world start with. And term insurance forms the basic of any financial planning, where you take, say, depending on what your human life value is, you calculate what is the cover amount that you would need, and then compare different type of plans that different companies give and choose what add-on covers are there or what type of plans exist, because there are a lot of new age plans that are coming in, and then you buy one. Now, once the term insurance plan is taken care of, which is the basic rock solid foundation is taken care of for your financial planning, then comes your next step, which is basically, would you want to save for something else, which might be a child education, or which might be for, say, retirement purpose, and so on and so forth. Now, in order to fulfill those needs, that's where the rest of the plans would come in. where you would look at returns or what would you get, or whether you want it as a guaranteed product or whether you would want as a market linked product where you get larger returns and so on and so forth. So they both cater to a very different needs, and that's where people really don't differentiate between them,
Sure.
and that's where the entire confusion comes in. So basically, or everyone should basically make the basis of a financial plan, which is the term plan. That's what they should take, and then move on to the next steps of whether it's about investing for say child education, or for say a medium term some financial goal, or a long term say retirement corpus, and so on and so forth.
Absolutely understood that point very well, because in case people think of buying an insurance policy just for the sake of getting some returns, they might actually, for the affordability factor, go in for a cover which might not be adequate. So we will discuss this factor again to understand what is the best and the adequate cover that one should go for. But before that also, I want to take a step back to understand who exactly should buy a term policy. I mean, should it be somebody who is earning in the family? Should it be both, the spouses who should go? Because most of the women, they might have started investing, but usually they forget to insure their lives. So help us understand who exactly should get a term insurance policy.
So, term insurance policies for those who has ideally any kind of dependence, right? Now, earlier it was majorly only financial dependence, but I think with the world changing, it's coming out to be not only exactly financial dependence, but a kind of a derivative of that. I'll tell you what does it mean. For example, there's a working person in a family who's the main breadwinner, and basis his or her income is what the entire family runs. Tomorrow, if death is to occur with that member, then the family would suffer a financial loss, or for their future, and it would there should be some corpus that will take care of it, right? That's where the term plan comes from. So anyone who has a financial dependence for sure should take a term insurance. There's no doubt about it. Now, apart from that, there are also people who feel, who are early earning in the, say probably about 25, 28 years of age, who are early in the earning category. And at times, some of these people say, no, I'm not married right now, or I don't get married by about 35. My parents are still earning. They might retire only 3 years down the line. Then they will become dependents on me, so on and so forth, right? Now, that is one segment which actually does not see really this thing. But the reality is that they themselves also should get covered, because at some point of the time you're going to have some liabilities on you for sure. Whether it's about you wanting to have a home loan and buy a house tomorrow, or you might actually want to work, and then probably 3 years down the line you want to gift a car to your parents, or you want to take care of their lifestyle to an extent that you want to give a world tour for them. But if death was to occur during that time, even that is part of your goals, right? Which is not going to happen, kind of, right?
Yes.
Or the other side of it is, term insurance, the way it works is you get it easily when you are healthy, fit, and fine, and at a much lesser premium. As you age, the premiums also increase. And as you age, if there are any health issues that come up, you might find it tough to get a term plan also.
Sure.
So the way it should be is, even if you're early 25, 28, or 30 years of age, you should take one for, say, if not for the entire human life value, at least, for about half of the human life value. And then take it when you get married, or when, your parents retire, and or when you take a loan, rather than leaving it for that, thing to happen, and then realizing, okay, you already have a hypertension on that day, which means you have to pay 50% extra premium. And vis-a-vis, looking at how term insurance prices have risen over the last 30 months, right? It's clearly coming out that, we always take this example when we try to explain to someone. A 30-year-old trying to take a policy of 1 crore till 60 years of age today, versus someone delaying it for 5 years and taking it at age of 35, but covering still only till 60 years, right?
Yes.
Would actually pay higher in the second scenario than the first scenario, and even also not have a cover for that 5 years, between 30 to 35 years of age.
Absolutely.
So all of this turns to a point saying that, ideally, even those who are in the early younger ages should take it, because there's going to be some dependency that's going to get created at some point, given the price rise and other things that keep happening, with inflation. So that will be taken care of. So that's one segment. The second segment is the emotional and not so visible financial dependency, which is what's coming out now as a homemaker segment, or the housewife segment.
Yes.
So what people, I think there's been a judgment last year from the court also, where they said, while homemakers or housewives don't contribute in financially, they don't bring in the money, but there's a lot of effort that they put in the family. They take care of a lot of stuff which you'll not be able to do. So a simple example, not related to judgment, but a simple example, right? So for example, if there's a housewife who's taking care of the family, and tomorrow the wife passes away for whatsoever reason, then the husband might not take up similar kind of job roles what they are taking today. They might not, they say, okay, I'll not travel, I'll not be in a sales job where I'll travel regularly, or I'll not take up so aggressive job because I have to be with my daughter or a son, or I
Yes,
have to take care of
yes.
my ailing parents. So there are a lot of
More
stuff that's
work-life balance.
yeah. So there are lots of things that are linked to it, right? Now, which means there is a human life value to the homemakers also, although there's no financial income that's coming in directly.
Yeah.
That's other segment which is evolving very fast, and where we're seeing a lot of homemakers taking policies, housewives taking policies. So these are the two evolving segments that we see
Yeah.
from who is to take a term policy.
Understood. So definitely those who are earning, but those who are not earning, but also contributing greatly to their families, and they have their families dependent on them, must go for a term plan. And also, the earlier, the better. In case you are in your early 30s or maybe in your late 20s, go for it for sure, because that will help you save up on some of the costs and the premium costs as well. Now, very important point that you made in your answer, that points me to my next question. For how long should one take this cover? Has it to be for the age of 60 years, up to 70 years, up to 80 years? Because the life expectancy is also going on. So what is an ideal duration for which somebody should go for a term plan?
See, it's actually, it really depends on person to person, right? So as we
Yeah,
say always that, whenever you're trying to buy a term plan or any insurance policy, first compare and then purchase, because what your requirements are very different from your friends or your family members,
true, true.
right? So this is another thing which, is very different for everyone. And there are different types of policies that exist depending on what is the kind of cover that you're planning to take today,
Okay.
especially with the
Okay.
new age features that are coming in. See, ideally, uh, earlier it used to happen with our parents that they know that there's a definitive timeline of retiring at about 58, 60 years of age, or
Yes,
VR is
yes,
around that time. So whatever it is, it's only till that time, and then they would have taken care of everything by then. So there's no really income earning and all of that. But with the
sure.
today's population, it's really a bit here and there, because while some people say I don't think we'll go and retire by 60, but then there's also other group that says there seems to be a lot of burnout that's happening, and we might even retire
Yeah,
early. So I think there's a lot of flexibility that's required. But what happens in a term insurance or these policies is that you have to choose a term till when you want to cover, and your premium gets
yeah,
decided, right? So there are also new age products that came in now, which brings us to the point that what are the kind of term plans, right? So
absolutely.
there's a pure term plan, which basically, as I said, you pay say 500 rupees every month, you get 1 crore cover for next 30 years. If death occurs, 1 crore comes to your family, otherwise nothing comes back. Then there's a term written off premium, which has also existed for a while now, where the premium is 2x. You end up paying 1,000 rupees per month, and you get the same 1 crore cover. But if death doesn't occur, you get the 1,000 rupees back, exactly whatever you paid at the end of, say, whenever that 70 years or 80 years of age or whatever it is. But then there's
Understood.
a new category which is evolving, which is almost kind of coming at a kind of a zero cost to consumers, which is coming to kind of called as a, say, zero cost term plan category as such,
Okay.
which is
Okay.
basically if you're taking a plan which is basically covering you till say 70 years, 75 years of age, you get an option at the age of around retirement, which is around 55 to 65 years of age, kind of, where you can say, okay, I don't want this cover any longer, just shut this plan. And then you get all your premium back, whatever you paid to the company, which makes it zero
That's
cost.
interesting.
So
Yeah,
it's so basically basis your requirement of what it is, you might want to decide. But what we are looking at right now, I think a lot of people deciding is they would want it to be flexible. They don't really want it to stop it at 60. So they want to take it till say 75, 85. But they're really not sure about that. And then this is what is coming out now with a lot of consumers feedback and all of that, that you take till 75, 80, then
yeah.
that's fine. Then you get this option of a zero cost term plan. So that's one which is evolving. And again, bringing back to it now, but depending on your requirements and your age, and whether you're clear in your mind about your retirement or being flexible,
Sure.
you might want to choose which one would suit you the best.
Understood that. So that brings me to the point of understanding, how much cover is essential. Since we are talking about this 1 crore, is 1 crore the ideal cover that one should go for? Does it depend on certain factors that one should know? How do you derive at that cover that you should have as adequate cover?
See, I think there's no number to it. I think this 1 crore wala part somewhere over a period of time, everyone across the industry has spoken about it. And I think that 1 crore has remained 1 crore over
Yeah,
last 8 to 10 years, unfortunately. And today also, people as a result end up buying 1 crore. But there's something called as human life value, which determines
yeah.
what your life is worth for your family's financial future. And that determines how much you should ideally have. That a way to good way to calculate human life value is a long list of things where your income, your future inflation, your future family needs, all of that comes to your liabilities, assets, and then you arrive at a value. A very shortcut to that insurance companies also follow to determine human life value is a multiple. If you're below 35 years of age, then 25 times of your annual income. If you're between 36 to 40, then 20 times, and so on and so forth. So that determines what is the life cover ideally you should have. Now, for some people it might sound crazy, but let's take an example of someone who's about, say, 20 lakh earning member, whose age is about, say, 30 years. Now that means a multiple of 25 times makes it 5 crore. Now that person might say, why do I need 5 crores of cover? Are you really serious about it? Now, but if you look at the math behind it, what would happen tomorrow if this person passes away and the family gets 5 crore? They're not going to invest it in, say, stock market or real estate, or which would give, where there'll be a lot of fluctuation, and there might be a, thing of written also, right? But they would ideally put that in a fixed deposit where they're sure that this is written. And a long-term fixed deposit, there'll be a slight rate increase at this point of time, but over a period of time, the rates are bound to go down. So, and that is going to take care of their family's future financials for the next 30 years. On a 30-year basis, if you look at a fixed deposit, over a period of time and post taxes, because there's also taxes on the fixed deposit returns, might only yield you about 3%. Now, what the 3% on 5 crore means is 15 lakhs on a long-term basis. So you might get actually 25, 30 lakhs now, and you might get 3-4 lakhs probably 30 years down the line. But on average is what I'm saying is 15 lakhs is what the family will get. Now, 15 lakhs is what the family will get on average. And that 15 lakhs will take care of their lifestyle, given that this person's income is 20 lakhs today. But if you take 1 crore on a long-term basis, 3 lakhs is what your family is going to get in your absence. Now, 3 lakhs is 25,000 rupees a month. Now, do you think that will take care of their needs in a realistic way? And why are you taking term insurance? You're taking term insurance because you want them to maintain the same lifestyle, even if you're not around, not for them to decrease their lifestyle and so on. So ideally, not to go by figures, you should ideally calculate what's your human life value and what's possible, and then also determine basis your paying capacity. Now, what do you want to do? Rather than just saying, my friend said 1 crore is best or 50 lakhs is best, and let me also take that. That's unfortunate. That's where a lot of people tend to move into without calculating. But this is what they should ideally do.
Understood that. Now, also, there's a lot of confusion about what riders are available with your term policy. Should you go for some riders or not? I also was reading somewhere very interesting point about salary protection insurance as a part of your term plans. Help us understand what these riders are all about. Should one really go?
So, in a term insurance, as I said, the basic thing is you pay amount. And in case of death, the family gets that amount. In case of no death, then the money doesn't come back. Or in case of zero cost term insurance, as I said, you have an option to even shut down the plan and take all the money back, making it zero cost. Now, there are riders available in all of these plans. There are like additional options where you can pay some extra money and get this covers. There are different types of riders that are available, namely, accidental death benefit rider, or accidental disability rider, or a critical illness rider, and so on and so forth, or a premium holiday rider. Okay. Now, these riders give you additional cover over and above what you are getting in the term plan as a death coverage. So, for example, there are different age groups who should take, there are ideal ways of taking a rider, right?
Yeah.
So, for someone who's young, and who, for younger people, a lot of deaths might actually happen due to accidents, right?
Yes.
So, if you are tending to, wanting to go for, say, a 2 crore cover, but because of your income, you're not eligible for 2 crores, or you're saying, okay, why do I pay so much for 2 crores? I want to pay for only 1.5 crore. Then you take a 1 crore of term cover with a 1 crore of accidental death cover rider. Because what happens is the accidental death cover might only cost you about 25 to 40% of what the term plan would cost you, right? So if you're paying, say, 1,000 rupees a month for 1 crore, with under 1 crore of accidental cover, your premium might come out to, say, 1,400 rupees only. Instead of, whereas for a term plan of 2 crore, it costs you 2,000 rupees, right? So it's an effective way to use that. Similarly, for those who are in the middle age of, say, 35 to 45 years, as we know, critical illnesses are what, they're around irrespective age these days. So critical illness is one thing where it happens. It's a large disease. So, at that point of time, you would want a 2-month break, 3-month break. You might have to, work, take a break from your work, leave without pay. Or you might want to go for, multiple checkups with multiple doctors, multiple opinions.
Yes.
Whereas your health insurance would cover when you get hospitalized, but who takes care of all of this costs?
Absolutely.
So critical illness cover, what it does is, for a small amount of premium, in case of a diagnosis of critical illness, it gives you that lump sum. Now you do whatever you want. While your health insurance will take care of hospitalization, you utilize this fund to do whatever you want, whether it's to subsidize your work. So there are different needs of these riders. So depending on what your age is and what your current need is, you might want to opt for one of them, or the premium, as I said, premium holiday rider, which is one of the new ones. Basically, where in case of, like COVID period, when people lost their jobs, so they were not able to pay premium. In future, if such a situation arises, you get option once in 5 years or once in 10 years between different companies, where you can skip the premium for a year.
Okay.
Still your policy will be active.
That's wonderful.
And then after 1 year, you pay from the next year onwards. You need not even pay this premium also. This premium is skipped, basically.
Oh, okay.
So that's how it takes care of. So these are wonderful things which add on to additional benefits and has very small costs. So you should also identify which one suits you the best and which is the one that you need, and then take that along with it.
That's wonderful. Now, in the end, Sajja, help all our viewers really understand what are the top 3 or 4 key things that one should know, because most of the millennial viewers of ours, they get very confused. They don't know where to start. So the 3 or 4 key things one should know before buying a term policy now, something that their insurance agents might not be telling them.
So one is basically, when you're deciding to buy a term plan, decide how much life cover do you need. Basis your human life value rather than just going by what someone would have said or something, what some ad would have told, right? That's the first and foremost thing that you decide. The second thing that you decide, and second thing that you do is decide what do you want to cover yourself till, whether you want to cover yourself till 60 years, 70 years, 75 years, because as I said, there are different covers that are there, and with new age plans coming in, where, as I said, probably the zero cost term plan category as a category that is evolving now, where probably if you're taking cover till age of 75, 80, you get that option also, where you get all your premium back when you exit the plan at the age of 60 years. With these things coming up, you might want to figure out what is the exact thing that you might, what might suit you in the right way. And then with this basic things, compare what different insurance companies are providing you, because there's always a different plan. There are a number of companies which are available in the market, and every plan is very different, and they have different features within them and different riders within them. So again, as I said, right, everyone is different. Had every human be same, then probably there would not have been so many people and so many opinions in our daily life. So
absolutely understood that.
Yeah. Everyone's family needs are very different. So you might want to compare different plans and choose what plan suits you the best with what riders and what kind of death payout option. Because there are also plans which pay out death benefit in lump sum. There are plans which give an option of your family not receiving lump sum, but giving a monthly income for the next 20 years or 10 years, or lump sum plus monthly income. Because, sometimes what happens is when a chunk of money comes in, at times it's also known to be, kind of done away with very soon between whatever happens in the family, right? So there are a lot of ways to handhold it if your family is not so financially savvy to manage a large corpus also.
Absolutely.
Hence, comparison becomes a one important thing. So decide what is the amount of cover that you need, till when do you want to cover yourself. So do you decide whether a regular term plan suits you best, or a zero cost term plan category suits you best, or a return of premium plan suits you best, and then compare different companies' plans and riders, and then you choose what suits you in the right way.
Absolutely. Those are wonderful insights. So thank you so much, Sajja, for sharing all of those with all our viewers. I'm sure this would have definitely given them clarity about how to approach and how to buy the right term policy for themselves and for their family members as well. Thanks a lot for joining in. It's been a pleasure speaking with you.
Thank you. Thank you, Sakshi.
If you like the video, do like, comment, share and subscribe.